Have you ever wondered why sometimes things that happen somewhere far from our country can give impacts to our everyday living? Let's say people in Europe can lose their jobs because of the crisis that happened in the United States. How does it relate it? Financial system is a system that allows the transfer of money between lenders and borrowers. These parties involved in the system consist of many levels, from individuals, local firms, banks, governments, to global organizations. In global level, financial agencies include the International Monetary Funds, known as IMF, central banks, World Bank, and multinational banks. Examples of financial agencies' activities are government issuing bonds, central bank lending money to commercial or investment banks, banks lending money to private firms or individual creditors, and many other activities, regardless of national borders and currencies. The relationship between these activities creates risks. This could explain why local crisis in the US could lead into global financial crisis. How fragile is it? Some economists agree that the world's financial system nowadays is far more fragile than it was in 2008. Financial fragility means the vulnerability of financial system to fall into financial crisis. It is so fragile that it could lead into a domino effect to other parties. For example, if Greece's economy somehow collapses, it can lead to economic collapse of other European countries. One of the impacts of a financial crisis is high number of unemployment. When people become unemployed, they will find it's very hard to fulfill their needs, let alone pay their taxes. If there are only few citizens that are able to pay taxes, the government income will be decreased. And when government have less income, its ability to provide public facility and service for the citizens such as building roads, hospitals, and schools will also be decreased. Then what's next? Higher unemployment rate, less facility and service, then the panic will start. Financial panic could be triggered by several reasons, such as excessive budget deficit, credit bubble, and uncontrollable capital mobility. Here are some examples of financial crisis and how it happened. The first example is the European crisis. European Union is a politic and economic union of 28 member countries in Europe. The members' economy is regulated by a European Union and is closely attached to each other. When one of the countries' economy is experiencing positive progress, the other countries will also feel the positive impact. When one country's economy is falling, other countries might fall as well. This problem is currently happening to Greece, and it's affecting the whole European economy. The second example is the US financial crisis in 2008. It was caused by the collapse of one of the biggest investment banks. Investors lend their money to the bank so the bank can lend it to people to provide house credits. In the beginning, when somebody wanted to borrow money from the bank, they need to meet lots of requirements. If the person doesn't meet all the requirements, the bank won't lend the money. But since the house price keep increasing every year, the investors saw it as a good opportunity. Therefore, they want more people to borrow money from the bank, so then these investors would get a lot of profits. Because of that, the bank and investors agreed to lessen up the requirements on borrowing money, resulting more people that able to get loan from the bank to buy houses. In the long run, many people were unable to pay their debts. Well, it was okay for a while, since the price of houses was still increasing. But when more people were unable to pay their debts, more houses were returned to the bank. Therefore, many houses were listed for sale. And since the house supply was higher than its demand, the price of houses decreased. This situation influenced people not to pay their loan even though they were able to, since the house price keeps going down and down. This causes chain of defaults, and the banks cannot collect their debts back. Thus, the bank was not able to pay back their investors. That's why the US financial crisis happened. The third example is the 1997 Asian financial crisis. The crisis began with the collapse of Thailand baht, then followed by a crisis in South Korea, Malaysia, and Indonesia. Some economists agreed that the cause of the crisis is because there was a rush in capital inflows to finance investments and made them vulnerable to a financial panic. When a country gets a foreign investment but didn't have proper regulations, this may lead into disaster when foreign investors suddenly took back their investments. The panic and insufficient policy responses caused a financial crisis in the region, which until now, some countries are still trying to recover. So then, why this panic happened? It happened because there was a gap in the system and some people were taking advantages of these conditions to benefit themselves. As a result, it damaged the whole economic system and impacted many people. Last but not least, how to prevent this from happening? To prevent it, we need our financial activities to be well regulated. This does fall to the government and central bank. There are 5 main things that should be regulated: credit policy, trade policy, deposit protection, fiscal policy, and monetary policy. Good credit policies are required to maintain a person or institution's credit in safe and reasonable level. As explained before, these policies can minimize the domino effect of bad credit affecting the good credit like the one happened in US. Trade policies should be made in certain way to keep the trades between the country and its partners regulated and well organized. This should keep the trading activity simple, stimulate more trade, and also eliminating bad factors such as complex bureaucracy and hidden costs. This will increase the country's productivity and generates more tax revenue. Besides the preemptive actions mentioned in the first 2 points, the government also needs to do protections. For example, in US, they have Federal Deposit Insurance Corporation or FDIC. Its main function is to provide the deposit insurance guaranteeing the depositors' accounts. FDIC's insurance should keep the depositors calm from sudden withdrawal and keep the bank from running out of cash, which could lead to bankruptcy and spread up to other banks and creating financial crisis. The last two are fiscal and monetary policies. The role of fiscal policy is determining how much money the government will collect and spend, while the monetary policy is controlling the total supply of money in circulation. All these policies should be made specifically according to economic conditions and environment for each country. But despite all the efforts done by the government or even the private business to prevent the financial panics from happening, many economists would still argue that the next crisis isn't far from happening. Another effort that can also contribute in preventing the financial crisis is to educate the people. Educations will give more understanding of how financial system works, and we are hoping the more we learn, the more we know about how to minimize the effect of the financial crisis. So, what about your country?
Stir my heart like a beef in